On June 12th, the Nasdaq executed an algorithmic sequence that inverted the intraday trend. The session ended in a violent vertical V-shape reversal, wiping out standard structural positions. This was a continuous, uninterrupted run from the session lows at 29,250 straight up to the highs at 29,784. Many retail traders look at sudden reversals of this magnitude and assume they are random anomalies, or perhaps sudden reactions to breaking news events. The data shows a different reality. These market behaviors are precisely engineered algorithmic mechanics, designed specifically for institutional liquidity hunting. Surviving the modern Nasdaq requires abandoning the illusion of random price action. The market operates as a rigid structural machine, governed by order flow algorithms. This diagram displays the analytical framework required to decode these traps. We use a proprietary split-screen dashboard. Standard candlestick price action sits on the top half, while a momentum histogram tracks order flow on the bottom half. We call this engine telemetry. Measuring its velocity relative to the zero baseline reveals true institutional intent. We will use this telemetry to deconstruct the regular trading hour sequence of June 12th, step by step. We will track the anatomy of the sequence in distinct phases, identifying the false opening breakdown, tracking the deep institutional stop run, and predicting the final statistical target. Relying solely on structural price levels without validating the underlying order flow momentum leaves an operator blind to incoming institutional traps. This chart shows the pre-market setup during Phase 1. The market established clean structural support, holding steadily above the previous day high at 29,544. To the untrained retail eye, this specific pre-market structure presented a bullish narrative of sustained stability. Then the 0630 New York cash open triggered. The moment the bell rang, an immediate and violent divergence occurred. On this split-screen dashboard, the trap becomes visible. While price drops, the engine telemetry in the lower panel instantly slams downward, crossing deeply below the zero baseline. This data signature represents a deliberate cardiovascular collapse of market momentum. Driven by this heavy negative expansion in the engine room, the price action cascaded aggressively downward. The drop sliced straight through the center pivot at 29,450 and immediately broke the previous day close at 29,430. The institutional logic here is calculated. This deliberate stop run is engineered to trigger systemic panic and flush out late-stage breakout buyers who set their risk against those exact structural levels. The retail traders who bought the pre-market stability are now experiencing localized shock as their assumed support fails. A pristine structural support level is meaningless if the underlying telemetry data simultaneously registers a systemic momentum shock. The market has now entered a phase of severe hemorrhage and extreme liquidation. This chart tracks the resulting collision. Price cascades down to strike the heavy macro support floor, defined by the mid-L at 29,322 and the hourly pivot high at 29,250. At these critical macro boundaries, we observe the structural rubber band test. The candlestick bodies hold the line, while sharp vertical wicks spear deep past the mid-L support wall, hunting retail trailing stops. This wicking action actively sweeps resting liquidity at wholesale pricing. We validate this sweep by looking at the telemetry. The negative histogram bars have reached their maximum depth and are now curving back upward, forming an exhaustion curve. The velocity decay in the momentum histogram correlates directly with the price wicks on the chart. This proves the institutional chassis successfully absorbed the collision. Institutional boundaries function as elastic suspension zones designed to absorb panicked retail selling while accumulating wholesale positions. The end of the liquidation phase is confirmed by a specific system alert. Target: bearish liquidation sweep, exhaustion loop detected. This indicates that retail shorters are now trapped at the bottom. The immediate price reaction is violent. Massive institutional block orders execute, yanking the price candle back up before it can officially close below the structural boundary. The precise geographical marker of this reversal occurs when price physically reclaims the central mid-boundary at 29,390. Correlating with this price reclaim, the secondary telemetry trigger fires. The histogram violently explodes back over the zero baseline into positive territory. Right at this turn, the system outputs a proprietary true C synchronization print. A true C-print means the fast, 3-minute execution algorithms have locked teeth with the higher timeframe macro moving averages, aligning the entire order book. Reclaiming a central pivot immediately following an exhaustion sweep provides the definitive validation of an institutional trap. The algorithm has officially triggered its counterattack. The immediate aftermath of the true C-print creates a textbook sympathetic adrenaline dump across the market. Late-entering retail shorters who sold the bottom are suddenly trapped out of position. To limit their losses, they are forced to buy to cover. This mass covering removes supply resistance from the order book, creating a vertical runaway short squeeze vacuum. This chart tracks the resulting vertical glide. Price expands relentlessly upward through the remainder of the morning session, encountering zero structural friction. The mathematical precision of the move reveals its true nature. This is a guided algorithmic missile aimed at a specific macro target. That ultimate target boundary is the H1 session average high and bearish expansion line at exactly 29,784. Algorithmic short squeezes do not push forward until they simply run out of energy. They expand to execute cleanly at predetermined, mathematically fixed statistical ceilings. Once price reaches the 29,784 statistical ceiling, the market enters a state of heavy compression. Returning to the dashboard, we locate the exit signal. While price flatlines against the ceiling, the positive telemetry histogram bars slowly shrink toward the zero line. We define this fade as velocity decay, or a high RPM idle, indicating macro momentum has plateaued. Velocity decay at a macro statistical extreme is the exact mathematical footprint of institutional profit-taking and a transition into stable recovery. The daily rotation is complete. The machine delivered a clean-cut macro execution from the exact statistical lows to the exact statistical highs. The core vulnerability of the retail trader is reacting to standard structural breakdowns without verifying the underlying engine telemetry. The core advantage of the proprietary operator is mapping order flow exhaustion against fixed chassis boundaries to predict institutional pivots before they happen. Operators who map order flow exhaustion against fixed boundaries can treat intraday volatility as a mechanical, predictable diagnostic sequence.